Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to another live stream. Sorry to those of you in the chat, a constitutional stacker who are being a little impatient there, but I have arrived. Happy Friday, everybody. Let's give just a moment here for some more people to get into the live stream. If you can hear me loud and clear, just put a 1 in there. And today we're going to talk about asset bubbles. Going to talk about a number of things this evening, actually, in this live stream, but I do want to talk about asset bubbles. So what you're looking at is the chart of NVIDIA. We'll talk a little bit about the market action that we saw this week. So the big news was NVIDIA earnings. NVIDIA is the darling of this AI stock rally that we are witnessing. Now, is this a bubble? There are those who would say it is. There are those who would say that NVIDIA's valuation is justified by the revolutions that will be brought by AI. I don't know if that's the case or not. I mean, I suppose it could be. I tend to view this as more of a bubble. But this isn't the biggest bubble that we are in the midst of, believe it or not. No, this is a symptom of a bigger bubble, an everything bubble, a dollar bubble, a debt bubble. That's really what we're going to be talking about today, but I just wanted to comment on this because this really shows that the bubbles that the Fed has been inflating, there's been no end to this. You know, this tightening cycle, not really a tightening cycle, as you can see. Paper assets are at new all-time highs. The NASDAQ, the S&P 500, it is kind of concentrated to a small number of stocks, but nonetheless, paper assets are being inflated to massive new valuations. It's really a sign that inflation isn't under control. You know, inflation continues to creep up, and I think one important thing to point out here is that NVIDIA, they're based in California, but a lot of what they depend on for their dominance in the AI chip market relies on Taiwan. Taiwan, we know, a highly contested territory between the U.S. and China. In fact, this is from just yesterday, China demanding that the U.S. stop any official contact with Taiwan following a congressional visit. So they're, continuing the bombastic rhetoric over Taiwan, which, they claim is not a country. They claim it's theirs. I don't know. I mean, I guess that's up to Taiwan and China to figure out, although I imagine the U.S. is going to have a lot to say about that because all these high-tech chips are coming out of there. Thank you very much, Jeff Tooley Tiger Thomas, for the memberships, which he has gifted there. Appreciate that. But the bubble we're going to talk about today, again, is not NVIDIA. I think that there maybe is some reason to be cautious about this because of their dependence on technology from China, and also, or from Taiwan, which is under direct threat from China. Also, it's possible that NVIDIA could lose its dominance in the AI market. They control something like 80% of the AI chip market at the moment, but there are some competitors out there. There's AMD. They are fielding some new AI-based chips. Intel, who's going to be getting a lot of money from the U.S. federal government as they try to boost domestic chip production capabilities. So, I wouldn't be surprised if this move up that we've seen in NVIDIA becomes unsustainable. But I also want to talk about this bigger bubble and what it's going to mean for gold and silver. Don't forget, if you want to get your hands on some real money, some gold and silver, you can do that at SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/news. So check them out. That's where I buy my precious metals. Now, here is a sign of the real bubble that we're looking at. The big bubble, the everything bubble, the reason that so much capital has been funneled into paper assets following the great financial crisis. And really, this has been something that's been ongoing since then, round after round of massive deficit spending, round after round of quantitative easing, which has monetized a good portion of this debt. a trend which is likely to continue, if you ask me. Interestingly enough, this week was a great week for those AI stocks, the tech sector, Nvidia. Gold, however, also had its best weekly performance of 2024 so far. So that's something to keep an eye on there. But still, gold really not doing much. Year to date, gold is actually down 1.33%. Silver is down 3.17% year to date. Let's take a look at this asset here, which many have accused of being in bubbles in the past, Bitcoin. Myself included. There was a time when I thought that Bitcoin's rise was a bubble. It's had several of these spikes now. I know a lot of people back in 2018, 2017, that time period, then when we had that big spike up, we're calling that like a tulip mania. I think we heard the same thing here, but I've come around on Bitcoin, at least to some extent. I don't think that it has been a tulip mania. Tulips did go up vertically like we saw here in 2021 with Bitcoin, but then it came back down and never went up again. Bitcoin is, back up approaching all-time highs. It's not quite there yet, but it is on the move. But I do think that one thing that Bitcoin is indicative of is the amount of dollars that have just been pushed out there, inflating these asset bubbles, inflating asset valuations. I'm not saying Bitcoin is necessarily in a bubble at the moment, but it certainly has attracted a huge amount of capital over the years. And, I think that at least to some extent that could be responsible for why we've seen some lackluster performance in the precious metals. I do think some of that capital has been siphoned off. Individuals looking for inflation hedges, looking for alternatives to the US dollar. But also, I think a lot of the buying that has gone into Bitcoin hasn't been for that safe haven type status. A lot of it has been for speculation. And that is sort of indicative of the easy money environment that we're still in. Because, interest rates are the federal funds rate over 5%. Everybody's fixated on, is the Fed going to cut? Is the Fed going to cut? Well, they're going to cut, but everybody acts like 5% is like this super tight interest rate, and it's really not. And you can kind of tell that inflation is still rising. That's likely to persist. And I think that the reason that the Fed here has hesitated or paused their rate hikes is because they know, it's going to collapse everything. It's going to collapse the banking system. It's going to collapse the entire debt-based economy. And so, they need to keep rates at least where they're at, because markets right now are anticipating cuts. That's why we're seeing cash flow into the stock market. Everything is priced for more money printing, and I think that's likely what they're going to get. Speaking of inflation and a consequence of this dollar bubble, look at this story from the Wall Street Journal. It's been 30 years since food ate up this much of your income. Ongoing high costs lead food manufacturers and restaurants to keep prices elevated. Now, we know inflation is moving back up. We got the January CPI. It was hotter than expected. That kind of threw some cold water onto the markets for a while there, but I suspect markets may be coming around to the fact that the Fed is likely going to cut interest rates regardless of what those CPI numbers do. In fact, I think it's more likely the Fed will probably just manipulate the CPI somehow. They'll change the methodology, they'll obfuscate things. Expect more of that as high inflation leads them to, hesitate to cut rates, but eventually it's going to become absolutely necessary for them to. And, I want to talk a little bit about inflation and this bubble that we've had of money creation relative to the velocity of money. Right now I'm reading the book, The Great Taking. Some of you have recommended that. Haven't made my way all the way through it, so I'll kind of give you my thoughts on that book once I finish it. But one thing that is mentioned briefly in the opening portion of the book is the velocity of money. And this is really an interesting chart to look at, the velocity of M2 money stock. This is the velocity of money, okay? Velocity of money basically means how many transactions are taking place for any individual unit of currency in the economy. And one thing you'll notice is that it's really plummeted. This chart goes back to pre 1971, so before the dollar was taken off of the gold standard. And it really was pretty steady right around 1.8 for decades. See a bit of a move up here as we head into the tech bubble in the 90s, kind of peaked here at over 2. It's coming down now here as you look, and then we enter the great financial crisis. Now the money printing begins, and you see the velocity of money dropping. And I just want to say hello. I see a lot of people in the chat saying hello, familiar faces. Hi, everybody. Hi, Michael K. Do me a favor, if you're watching, smash that like button. Help get this information out there. I'm just going to give you my thoughts on this stuff straight. I'm not, I don't really have an agenda here like they may have at the mainstream media. They want to tell you everything is rainbows and sunshine out there. The stock market's going to keep hitting new all-time highs in perpetuity. And, it may actually do that. But the thing is that the purchasing power of the dollar will, be declining. So in real terms, those stocks, the paper assets, may actually be losing value. But you can see it's been just falling off a cliff here, really dropping in 2020. Now, why is that? Well, it's because they printed so much money, so the money supply expanded massively. So the velocity of money, which is how many times each dollar is spent, declines as the money supply is massively expanded. But this kind of gives you an idea of how the diminishing returns on money creation play out, right? So the Fed and the government, working in tandem, can create this money. They can borrow it from the future, spend it into the now, goose economic activity. We always talk about the great GDP numbers that we're getting every quarter or every month when the government releases those. But much of that is driven by the massive deficits, which ultimately, guarantee high inflation down the road because they're all going to have to be monetized eventually by the Federal Reserve. But the thing is, as they keep doing that, the ability to goose the economy diminishes. You have to create more and more debt to get, the same percentage point of GDP. And eventually this will reach a tipping point. That, I think, is likely when we're going to see the everything bubble pop. It's going to be a combination of things. It's going to be the velocity of money potentially begins picking back up, which you can see actually it has begun to do. The most recent data from Q4, you can see the velocity of money kind of picking back up. Now, part of that may have to do with the Fed's program of quantitative tightening, kind of shrinking the money supply. So, as you see the money supply decrease, then you will see the velocity of money increase, assuming all other things stay the same. But you think about once this velocity of money really starts to pick up, and one thing that drives that in, say, a hyperinflationary economy is when people lose faith in the currency. Now, that hasn't happened yet. I mean, right now, I think everybody has a lot of faith in the U.S. dollar. They're, staying in it. They're getting interest. They're actually, for the first time in a while, getting a yield on it. If you've got a money market account, you're making more than 5%. Sure, inflation is ticking up. If they really understood how fast inflation is ticking up, not just the government cooked numbers, I think people would have a lot less faith in the dollar. But it's all a confidence game. That's the name of the game with a fiat currency. It's like as long as people have faith in it, they're going to keep using it. And when you're going to see the velocity of money increase, that's when people begin to lose the faith that they have in the currency. When they start spending the money because they realize it is devaluing. And one thing that you see in a hyperinflation is the velocity of money absolutely explodes. That's when prices begin to soar. That's when you see, double-digit, triple-digit inflation. And we're nowhere near that yet. But the thing is that when the bubble pops, that very well could be where we end up going. And, it's going to be a lot of factors. Let's take a look at the Fed's balance sheet here. You can see that they expanded it massively in the great financial crisis with QE, papered over a bunch of problems. For more than a decade, they were buying up government assets, monetizing debt to keep interest rates low, to keep the zero interest money flowing, keep the easy money flowing. That's what has inflated the massive economy, the massive economic bubble that we are in the midst of right now, with just the price of everything, the price of everything except seemingly silver moving higher, which is kind of interesting to note. It makes you wonder about that. It's like, how can all of this money flow into all these speculative assets, and yet silver just kind of languishes there? But When the money really starts to begin to flow to safe haven assets rather than speculative assets, I think we're going to see a lot of movement in the price of gold, and then it's going to be followed by silver. But let's take a look at this chart here. So we've got in 2020 a massive expansion of the Fed balance sheet, trillions and trillions of dollars. They actually tried to do quantitative tightening back in 2018. They started doing that, and then that blew up the repo facility, the overnight lending facility of the Fed. So they actually had to start reversing and buying bonds again before the pandemic, which is kind of interesting to note. Then, they shut the economy down, printed a bunch of money. That led to a bunch of inflation. How shocking is that? You shut down the supply of goods and services and you print a bunch of money and pay everybody to stay home, and it makes the price of things go up. It's truly a shocking mechanism there. And then, they kept doing QE for a long time, started to sell off some of these assets back in 2022 because inflation was almost at double digits, even according to the government, which, that means that the inflation was much, much worse than double digits. They've been selling it off ever since. Here's a little blip from March of 2023 when the U.S. banking system started to fail and they had to jump in there and bail things out. But now they're still kind of just resuming their quantitative tightening. Now, it's interesting. We got the Fed minutes from a recent FOMC meeting just the other day. And in that, the Fed kind of talked about their quantitative tightening and how they're going to be easing it and trying to bring it to an end. They want to do it. They want to shrink their balance sheet as much as possible without breaking something here. That's what they're looking to do. They may be able to do it for a while. They talked about extending it, reducing the pace of quantitative tightening. But here's the bottom line. Eventually, should there be a crisis, and one is almost guaranteed with the way things are moving along. You've got a huge amount of U.S. debt held by foreign nations like China and Japan. Those are the two biggest holders. We're on the verge of a major conflict potentially with the BRICS nations. They're de-dollarizing. China is drawing down its debt holdings. We know that if interest rates on U.S. Treasuries spike up, it's going to create a massive financial crisis in the banks. Many of the regional banks are insolvent. There's a huge looming commercial real estate crisis. We've talked about all of this in many live streams. So many reasons that the Fed isn't going to be able to have the interest rate on U.S. Treasuries moving higher. And it's going to be just like March of 2023, but much, much bigger. In fact, it'll probably be bigger than 2020, when this bubble really pops. And I think that is potentially when it becomes crystal clear to investors that the Fed's fight against inflation was doomed from the beginning. Inflation is going to be moving much, much higher. And that's when you could see a loss of confidence in the dollar. It's just speculative, thoughts on my part. There's no guarantee. I don't have a crystal ball. I don't know what'll trigger that. But look at the interest rate on 10-year treasuries. This is the 6-month chart. You can see back in 2023, we had this big problem in October when the yield on a 10-year treasury was approaching 5%. I mean, the banks really can't tolerate that. That will create a large loss on many of the positions that the banks are sitting on. They bought a lot of debt, the regional banks. They bought a lot of U.S. Debt when yields were much, much lower than they are today. The way bonds work, when the yields go up, existing issues of the bond that have a lower yield, they lose value. Who would want to buy that when they can buy the bonds that are being issued today at the higher interest rate? So the banks, they have all these massive unrealized losses. The BTFP, that program, the Bank Term Funding Program, the Fed started back in March of 2023 to bail out the banks, to provide emergency loans and taking on these treasuries as collateral. That's still near a record high. It's like at $164 billion, set to expire in March, by the way. I don't know how they're going to pull off that trick, but we're going to find out. So the time may be short on all of this. Let me pause real quick. I got somebody in the chat mentioning the balloon, which has been intercepted over Colorado. Yeah, pretty interesting stuff. I wasn't going to really talk about that on the live stream, but since the chat's going on about it, it is interesting that, a year past the Balloon Gate incident of 2023, there is reportedly another high-altitude balloon being tracked over Colorado. We'll have to see how that plays out. But back to the interest rates here. So, they've begun to tick back up. We had the Fed waxing very dovish at the end of 2023. Powell telling us that we were going to get rate cuts in 2024. They were coming, they were right around the corner. And you saw the yields come down. Okay, mission accomplished by Jerome Powell, except inflation then started to tick back up. The Fed has been much more hawkish since that time, telling us, well, we're going to keep rates high as long as we need to fight inflation. And, what do you see happening? Well, you see the yield on treasuries ticking back up. So if the Fed bails out on the rate cuts, you're going to see these yields spike up. It's going to cause a crisis in the banking sector. It can't happen. They're going to have to cut rates. I think they're going to have to resume QE here at some point. I don't know when. Is it going to be when China dumps its treasuries? Is it going to be when, some derivatives instrument that these banks are exposed to regarding commercial real estate blows up? Is it going to just be when, banks like New York Community Bancorp, which saw its share price drop by like 60 or 70% just a couple weeks ago after revealing losses on its corporate real estate loans? Is it going to be another loss on a loan like that, another earnings report from one of these banks? I don't know. I mean, there's a lot of things that could trigger a crisis right now. Not the least of which, is this. Look at this. This is the monthly Treasury statement for January. You can see that in January, pretty crazy, net interest right here, net interest at $68 billion, that's interest on the national debt, has actually surpassed for the month of January the expenditure for national defense. For the total fiscal year of 2024, that's not quite the case. You can see that it's actually national defense in the number 2 spot at $298 billion and interest at $283 billion, but that is catching up. And as long as the Fed keeps rates high, that is going to continue to be the case. And of course, if the Fed really wants to give the U.S. a break on the interest on our national debt, how do they do that? Well, they have to go in there and actually buy the debt to drive the yield lower. So we find ourselves in an unsustainable debt situation. I mean, the only thing moving up exponentially besides Nvidia right now is probably the U.S. national debt. I mean, the U.S. national debt absolutely exploding on a exponential path. It's not sustainable. It's the biggest bubble of all. When it pops, what's going to happen is the Fed is going to move in. They're going to buy up huge amounts of debt because nobody else is going to want it. People will probably lose faith in the dollar. And at that time, that's when you're going to want to have hard assets. I mean, will Bitcoin be a safe haven asset when the big bubble pops? We're going to find out, I guess. I'm not sure, but I do suspect that gold and silver will be something people want to really get their hands on. If you want evidence of that, all you got to do is go back to this little blip here on the Fed balance sheet. When that happened, when the banks were failing, I mean, you remember, if you're a stacker, try and get some physical metal back then. It was like 3-4 week wait times. When the bubble really pops, that's going to seem like an abundant supply. I mean, gold and silver, physical gold and silver, it's going to be a scenario where you may very well just name your price. I get some comments on videos sometimes, and I just dismissed them initially, but it's like they keep popping up, and people would say, well, if silver goes to $100 an ounce, who's going to buy it from you? And it's like, well, look, if an asset is $100 an ounce, that's by definition because somebody's paying that much for it, right? If gold is $10,000 an ounce, it's because somebody's paying $10,000 an ounce for gold. That's what a price is, right? It's where a buyer and a seller agree to trade an asset. And, who's going to buy it? Well, I don't know. Probably a lot of people are going to be very interested in getting their hands on some real wealth when that day comes. And again, you witnessed that back in March of 2023. I remember talking to the CEO over at SD Bullion, and he was telling me that not only was their order volume up, but the real issue with the packing times and the lead times were that they were getting orders, for $1 million worth of bullion, order for $500,000 worth of bullion. Like usually they might get those infrequently, and it was just like boom, 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 these huge orders coming in, and that takes a while to pack up $1 million worth of silver coins or whatever. So, when the real money starts coming into the physical gold and silver market, people always want to talk about gold and silver like they're these huge liquid markets. And it's true they are when you're talking about the paper markets, but the physical markets are a whole other beast. And, during times of uncertainty, when a huge financial bubble is popping, for example, when a currency crisis is occurring, it can be pretty tough to get that stuff. And, if you're holding a bunch of paper silver, a bunch of contracts, good luck taking delivery. You know how they're going to settle that, right? They're going to pause the market, they're going to give you some fiat currency, and they're going to say good luck. And there's not going to be enough underlying physical metal to back all that stuff up. So, get it while the getting's good. It's not financial advice, but I'm just telling you that, right now, everybody is in a state of euphoria. That's why you're seeing the S&P 500, the NASDAQ, everything hitting record highs. It's because people are very confident in the system. People are confident in the dollar. And, part of it is the fact that the dollar is the world reserve currency. It's still used extensively, but there's also a coordinated campaign by the media, by the educational system, you name it, to understate the effects of inflation, to obfuscate the nature of inflation, to dumb people down so that they have no idea why their money won't buy as much food. Again, it's been 30 years since food ate up this much of your income. From the Wall Street Journal, 2024. Inflation is a huge problem right now. It's going to get a lot worse. You probably want to get some food. Part of why food is rising is, there's a lot of dollars chasing it. There's also a lot of weird stuff going on with climate, with climate legislation, which is trying to drive farmers out of business. They look, you want to wear the tinfoil hat. They want you to own nothing and be happy and, eat bugs for dinner. And there's probably more to that than not. So, think about getting some food as well and upping your basic preparedness game, because when this bubble pops, it's not going to be pretty. And, there will be a flood of fiat currency, all that currency that's flown into all of these assets, flowed into them, into Bitcoin, into tech stocks, into real estate to some extent, into all of these more speculative assets. When it all flows into precious metals, or not all of it, it would only take a minuscule amount of gold, of the money that is going into these companies to flow into gold or silver to absolutely blow the price up. What was NVIDIA's move up? It was a record move, I think, in terms of their market capitalization. It was something like $200 billion. Now, I'm going to pull the calculator up here, but the annual production of silver, I don't know the exact number. It's something like 800 million ounces, I think. If you look at that and you multiply that by what is silver, like $23? Yeah, we'll call it that. That's, $18 billion worth of silver. That's a whole year's production of physical metal. And NVIDIA in one day moved up like $200 billion. So you can see that even a tiny fraction of the money that has flowed into these tech stocks flows into gold or also silver, the physical variety. The price is going to absolutely explode. So, let me know what you think about this in the comments. Actually, if anybody has any questions, or, I try to keep an eye on the chat as we do these live streams, but if there's anything anybody would like to ask or comment on, let me know, and we can kind of do some of that before we wrap this live stream up. After all, it's Friday night. I appreciate you spending a portion of that here on the channel. NVIDIA market cap is bigger than Canada's economy, Ryan says. Maybe. I'm not sure what the GDP of Canada is. I know that California itself, I think the California economy is bigger than Canada's. So, that's an interesting point. Dmitry Orlov's The 5 Stages of Collapse. Aussie Weinert says that. I haven't read that one. I'll have to check that out. Has anybody read The Great Taking? I'm sure some of you have, because you were the ones who recommended it to me. But it's an interesting read, and the author does a pretty good job of setting a stage for how central banks and financial interest are basically trying to confiscate everything. Again, I haven't quite finished the book yet, but it's an interesting read for anybody who is looking for something to read. Yeah, okay. I just see some folks saying thanks. Yeah, thank you to all of you for tuning in. And leave a comment down below if you're catching this later. I will catch you next time. Stay safe and happy stacking.